In 1972, Warren Buffett almost walked away from the best deal of his life. Over $5 million. He'd pay $25 million for a small candy company. Not a penny more. The owners wanted 30.
And that $5 million gap nearly cost him $2 billion. I've spent 50 years studying how great investors think. And if you want the exact moment Buffett stopped being a cheapskate and became a genius, this is it.
See's Candies wasn't just a purchase. It was a lesson.
The most expensive lesson he ever loved.
And the third thing it taught him? That's the one almost every investor still gets completely wrong. Here's who Buffett was before See's. He was a student of Benjamin Graham. And Graham taught one thing above all: buy cheap. Find a beaten-down company trading for less than its assets, take a puff of value, then toss it away. Buffett called these cigar butts. One free puff left. It worked. But it didn't scale. You can't build real wealth picking up scraps forever. Then his partner, Charlie Munger, started whispering a different idea. Stop buying bad businesses at great prices. Start buying great businesses at fair prices. And in 1972, a candy company put that idea to the test. See's Candies was a California institution. Beloved. Trusted. People bought it for birthdays, holidays, anniversaries. The owners wanted $30 million. Now look at those numbers. The company had only about $8 million in hard assets. Buffett, the Graham disciple, looked at that and balked. Paying a premium that big for $8 million in assets? That violated everything he'd been taught. So he drew a line. $25 million. He would not go higher. And here's the part that still gives me chills: he and Munger came within a hair of walking away over that last $5 million. Buffett later admitted if they'd asked for $5 million more, he'd have walked. And how dumb that would have been. Luckily, the sellers said yes. And what happened next rewrote the rulebook. See's had something Buffett couldn't see on a balance sheet. It had pricing power. Every year, See's could raise its prices a little. And customers didn't flinch. Because nobody comparison shops a box of chocolates for their grandmother. That's an economic moat. A business so loved it can charge more without losing anyone. And it barely needed new money to grow. Read that again. Over decades, the capital the business required grew from $8 million to just $40 million. A tiny increase. But the profits? Listen to this. See's threw off cash like a fountain. And Buffett took that cash and bought other businesses: Coca-Cola, more insurance, the whole compounding machine of Berkshire Hathaway. See's didn't just make money. It funded everything else. Since that 1972 purchase, See's has earned Berkshire more than $2 billion in pre-tax profit. On a $25 million investment. Think about that return. And Buffett has said it plainly: See's taught him the difference between a good business and a wonderful one. A wonderful business earns high returns on very little capital. Year after year after year. This is where most investors still get it wrong. They hunt for cheap. They chase the discount. But the real money, the generational money, comes from owning quality and holding it. Price is what you pay. Value is what you get. And remember, this is educational, not financial advice. Always do your own research. Past performance never guarantees the future. So here's the one idea to carry with you. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. See's wasn't cheap. It was worth it. That $5 million gap Buffett almost died on? It became one of the greatest bargains in history. Quality, bought with patience, compounds in ways cheapness never can. So let me ask you this. What's one business you'd happily own for 20 years without ever checking the price? Tell me in the comments. I read them. And if this changed how you think about value, hit subscribe. We do this every single day.
Tomorrow, we're breaking down a mistake that cost investors billions in the dot-com crash.
You won't want to miss it.